Good afternoon, everyone. Thank you so much for joining us today for our Small Business Tax Workshop. I'm Masood Chutani, the Director of the Taxpayers Help Center, and my co-host today is none other than Zach Golan.
Thank you for the
Zach, thank you
introduction.
so much for joining us today. We are thrilled to have everyone here today with us in this workshop, and Zach and I together will guide you through today's session, sharing valuable insights and provide practical advice to help you manage your small business tax responsibilities more effectively. So, Zach, before we begin this workshop, could you please introduce our organization to the audience, and then we will begin.
All right, thank you for the introduction. So the Taxpayers Help Center is a nonprofit 501(c)(3) organization in Northridge, California, and we operate two tax clinics. The first is our low-income taxpayer clinic, and we help taxpayers resolve their tax disputes with the Internal Revenue Service. And then the second clinic we operate is our VITA Volunteer Income Tax Assistance Clinic, in which we prepare income taxes for free. Also, we are an IRS authorized certifying acceptance agent for individual taxpayer identification number applications. Also, if you have any questions anytime during the presentation, you can leave them in the chat and we'll be sure to address them by the end of the presentation. If you'd like to connect with us, you can reach us by email at info@taxpayershelpcenter.com. Also through our Facebook at Taxpayers Help Center, Inc., a nonprofit organization. And then we are located at 9029 Reseda Boulevard, Suite 209, Northridge, California. And then our website and phone number are listed here. However, all of this information is on Google if you just type in Taxpayers Help Center. The Taxpayers Help Center helps taxpayers both locally and beyond. And since the services we provide are free, donations are important in supporting us and in helping the reach of our services. Any monetary donations are greatly appreciated. Additionally, those who can volunteer their time or expertise or also spread awareness are a great help. And so if you would like to make a monetary donation, you may do so at taxpayershelpcenter.com/make-a-donation. Or you can just go to taxpayershelpcenter.com and click on the tab that says make a donation, which I've circled here on this image. And again, anything is greatly appreciated as these donations allow us to do what we do.
So that's great. Thank you so much, Zach. So in today's workshop, we have a lot of useful information for you, which includes topics like the next slide, Zach. So we'll be discussing selecting the ideal entity type for your business, when to start your tax year, what are EIN numbers, how to deduct startup costs, business expenses and business tax credits. We will also discuss the difference between independent contractors and employees, which is a hot topic right now, self-employment taxes and estimated taxes, what they are, retirement plans. A lot of people don't discuss these things, but these are really essential for small businesses. So we'll discuss the different types of retirement plans. And finally, we want to discuss with you the best practices for keeping track of income and expenses. So Zach, let's begin.
All right, so first off, we're going to talk about sole proprietorships. So a sole proprietorship is the simplest and most straightforward form of business entity, characterized by having a single owner. This structure offers complete control and decision-making power to the owner, allowing for flexible and quick business decisions. However, it comes with unlimited liability, meaning the owner is personally liable for all debts and obligations of the business. This lack of separation between personal and business assets puts the owner's personal property at risk in the events of business financial troubles or legal issues. So for tax purposes, the business income is treated as the owner's personal income. All profits and losses from the business are reported on the owner's individual income tax return, specifically on Form 1040. The income is then taxed at the individual rates, which can simplify the tax filing process, but may result in higher tax rates if the business is highly profitable. Despite its simplicity, the unlimited liability aspect makes the sole proprietorship a riskier option compared to the other business entities with liability protection. So here's an example of a sole proprietorship. So let's say Joe decides to create a lemonade stand and Joe does business selling lemonade by himself. That would be a sole proprietorship and he would be liable for the debts of his company.
So I think, Zach, I want to add is that uh, when a small business owner is making that decision as to what would be the best type of entity for them, they need to look at the type of business they're in. For example, let's say that it's a trucking business. So a trucking business can be risky because it can create liability for the owner because the drivers are going to be out there, and God forbid if there's an accident, it could create unlimited liability for the business owners. And then in a lawsuit, for example, they could come after the owner's personal assets also. So the industry that the person is in, I mean, if it's a small business which is offering some services that offer no risk at all, in that situation, I think a sole proprietorship would be okay.
So next up, we're going to talk about partnerships. So a partnership involves two or more individuals who share ownership and management responsibilities of the business. This collaborative approach allows for pooling of resources, expertise, and capital. Each partner contributes to the business's operations and decisions, which can lead to a diverse range of ideas and skills being applied to the business. And then liability protection varies depending on the type of partnership. So there are two types that we're going to talk about. So general partnership and limited partnership. So in a general partnership, all partners share equal responsibility for managing the business and are jointly and severally liable for any debts and legal obligations incurred by this business. So this means that each partner can be held responsible for the business's liabilities, which can put their personal assets at risk. And then
Yeah, that's an important point, Zach, because sometimes the general public doesn't understand what joint and several liability means. Several means that each individual on his own or her own is going to be responsible for the entire liability, not just their share. So, for example, if it's a 50-50 partnership and there's a lawsuit for $100,000, both the partners together would be liable for 100,000, and each partner separately or severally is going to be liable for the entire amount.
right. So that's general, that's a general partnership. And then so in a limited partnership, there are two types of or rather in a limited partnership, the partners have limited liability. That's the protection is limited to their investment in the business. So limited partners typically do not participate in day-to-day management, and their risk is restricted to their financial contribution. So next, we're going to talk about flow-through entity. So a partnership is considered a flow-through entity, meaning that the business itself does not pay federal income taxes. Instead, the income deductions and credits of the business flow through to the individual partners. This structure allows profits and losses to be reported on the partner's personal tax returns, potentially reducing the overall tax burden. And then, so no income taxes paid by the partnership itself. So the partnership does not file a separate income tax return or pay income taxes as an entity. Instead, it files an informational return. So Form 1065 is the one that is used with the IRS. And this reports the partnership's income, deductions, and other relevant financial details. The partnership's tax obligations are passed on to the individual partners, who then report and pay their taxes on their share of the income.
So here I'd like to add something, Zach. Although there are no income taxes paid at the federal level, states, for example, California, for example, have a minimum franchise tax. So a partnership, when filing their state income taxes, are subject to a minimum tax of $800 per year. So there is a minimum franchise tax.
Got it. So partners are responsible for paying taxes on their share of the partnership's income. So each partner is responsible for reporting their allocated share of the partnership's income, deductions, and credits on their personal tax return. This share is determined based on the partnership agreement and typically reflects each partner's ownership percentage or other agreed upon allocation methods. So the income is taxed at the individual partner's personal income tax rate, which can vary depending on their overall income level and tax bracket. So next, we're going to talk about limited liability companies, but they're also called LLCs. So first off, they provide members with limited liability while allowing active participation in the business. So members of an LLC have protection from personal liability for business debts and claims similar to that of a corporation. At the same time, they can be actively involved in managing the business without risking their personal assets. So to establish an LLC, you must file a document called Articles of Organization with the state's Business Registration Office. This document formally creates the LLC and includes basic information about the business. So an LLC's operating agreement outlines the internal rules and procedures for managing the business. It details how decisions are made, how profits and losses are distributed, and the roles and responsibilities of each member. So, and then there's the self-employment tax. So liability for members depends on their level of involvement in the business. So members of an LLC may be subject to self-employment tax based on their role in the business. If actively involved, they generally pay self-employment taxes on their share of the LLC's income. If not actively participating, they may have different tax obligations.
So I'd like to add something here, a couple of things, Zach. Going back to the number of members in a limited liability company. So for example, if the LLC only has one member instead of two, for federal income tax purposes, it's considered to be a disregarded entity. So for example, let's say you own an LLC and you're the only member, basically, the IRS says, we're going to disregard you, and you will basically end up filing a Schedule C just as a sole proprietor.
Right. So it's more, yeah, right. It's a sole proprietorship if it's one person with
That
the
is correct.
LLC, and then two or more people would be considered a partnership, right?
Yeah. So also, the participants need to know that even though there's one member, uh, in the Internal Revenue Code, there's a special thing called the check the box regulations. So even that one member can make an election by checking a box on a Form 8832, and they can elect to treat that LLC as a corporation for tax purposes. So there is an option out there for even for a single member LLC.
Got it. Okay, so now we're going to talk about C corporations. So let's talk about the formation first. So it's established by filing incorporation documents with the state authority. And so to form a corporation, you must file specific documents such as the Articles of Incorporation with the state's Business Registration Office. This filing officially creates the corporation and includes essential information such as the corporation's name, purpose, and structure. The process ensures that the corporation is legally recognized and compliant with state regulations. So for limited liability, or there's limited liability for C corporations. So all shareholders have limited liability protection, provided the corporation is compliant with state laws. And then shareholders of a corporation are protected from personal liability for the company's debts and legal obligations, meaning their personal assets are not generally at risk if the corporation faces financial difficulties or legal issues. This
One thing
protection.
I'd like to note here, Zach, is that
Go ahead.
there is something called piercing the corporate veil. So basically, a corporation is respected as a separate legal entity only if you comply with all the rules and regulations and you respect that separation. If there is, for example, gross negligence, there's fraud, etc., on the part of the owners, then this limited liability protection will not be provided to those owners. They will be able to pierce the veil and then come directly after the owners if there is fraudulent activity or there is gross negligence on their part.
I see. So the protection applies as long as the corporation adheres to state laws and maintains proper corporate formalities such as holding regular meetings and keeping accurate records.
Absolutely.
Okay, so there's double taxation. So the corporation pays taxes on its taxable income. So a corporation is considered a separate legal entity and must file its own tax return. It pays taxes on its earnings at the corporate tax rate. which can vary depending on the jurisdiction and the amount of income. And then
So at the
shareholders,
moment, Zach, the tax rate in the United States for C corporations is 21% across the board. So that actually changed in the 2017 Tax Cuts and Jobs Act. So it's a very nice rate that corporations have. It's 21% across the board. So it is set to expire next year, but let's see what happens.
yeah, so that's the tax rate for C corporations, in which they are taxed at the corporate level, and then additionally, the shareholders pay taxes on dividends received. So when the corporation distributes profits to shareholders as dividends, these dividends are subject to personal income tax at the shareholder level. So this results in double taxation because the income is taxed once at the corporate level, and then again when distributed to shareholders. Okay, so now we're going to move on to S corporations. So all shareholders have limited liability provided the corporation complies with state laws. So shareholders of an S corporation are protected from personal liability for the corporation's debts and obligations, similar to a C corporation. This means that as long as the corporation adheres to legal requirements and maintains its corporate status, shareholders' personal assets are shielded from business liabilities. This protection is contingent upon following state laws and corporate formalities. And then an S corporation is classified as a flow-through entity, meaning that the business itself does not pay income taxes. Instead, the income deductions and credits of the corporation flow through to the individual shareholders who report these items on their personal tax returns.
So
This
Zach, do
setup,
you remember the form number that is used to show those items that are flown through?
I
It's the
believe,
K1. So the K1 actually is the form, the Schedule K1 basically will show all those flow-through items uh, which will flow on to the individual's income taxes.
got it. So this setup helps avoid the double taxation, which is typically associated with C corporations.
Mhm.
Okay, so S corporations do not pay income taxes directly, with some exceptions for prior C corporations in specific cases. So S corporations are generally not subject to federal income tax. Instead, they file an informational tax return and their income is taxed at the shareholder level. However, if an S corporation was previously a C corporation, it may still be subject to certain tax rules and liability from that period, such as accumulated earnings tax or built-in gains tax under specific circumstances. And then shareholders pay taxes on their share of income from the corporation. So this income is reported on their individual tax returns and taxed at their personal income tax rates. This pass-through taxation ensures that the corporation's earnings are taxed only once at the shareholder level. And then the formation for an S corporation is typically the same process as for a C corporation. So it involves filing articles of incorporation with the state, drafting bylaws and other state specific requirements. And then the key difference lies in the tax treatment of election, or excuse me, in the tax treatment and election of S corporation status, which must be filed with the IRS to obtain flow-through tax treatment.
That's a good point, and it's an important point because initially you have to establish a regular C corporation, and the word that you use was an election. So the taxpayer has to make an election if they do decide to convert the C corp to an S corp. They have to file the form 2553, which needs to be sent in within 3.5 months of the formation of the C corporation. So that election has to be timely also.
Got it. So now we're going to talk about the requirements for S corporations because not anybody can create an S corporation. There are specific requirements that must be met for you to be eligible. So the first is the corporation must be formed in a state within the United States. Second, there must be 100 or fewer shareholders. So this limit ensures that the corporation remains relatively small and manageable, and all shareholders must be individuals or certain trusts or estates. Other types of entities like corporations or partnerships cannot be shareholders with some specific exceptions. Third, no corporate, partnership, or trust shareholders. And there are some exceptions, but generally S corporation shareholders must be individuals. And then fourth, no non-resident shareholders. So all shareholders must be U.S. citizens or resident aliens. Non-resident aliens are not allowed to hold shares in an S corporation, and this requirement helps ensure that the tax benefit of S corporation status are restricted to U.S. taxpayers. And then lastly, there's one class of stock. So an S corporation is limited to issuing only one class of stock, which means all shares have equal voting rights and liquidation preferences. This restriction prevents the issuance of preferred stock, which typically has different rights and privileges compared to the common stock. This uniformity simplifies the ownership structure and ensures equitable treatment of shareholders.
So this is one of the reasons why the limited liability company, or the LLC, is probably one of the most favored type of entity, because it offers more flexibility. As you can see in an S corporation, they have all these restrictions on who can or cannot become a member and the number of shareholders, etc. So because of these limitations, the LLC is preferred.
Okay, so now we're going to talk about when to start your tax year. So now that you have figured out the best entity type to suit your business needs, you then need to decide what the tax year is going to be. So a tax year is a 1-year period where you keep track of your records and report your income and expenses. You have two main options for your tax year. So first off is the calendar year. This is the classic January 1st to December 31st setup. It's a full 12-month period and is pretty straightforward. So if you file your first tax return using the calendar tax year and you later begin business as a sole proprietor, become a partner in a partnership, or become a shareholder in an S corporation, you must continue to use the calendar year unless you get IRS approval to change it or meets one of the exceptions listed in the Form 1128. The second tax year you can use is the fiscal year. This is another 12-month period, but it ends on the last day of any month except December. So you can have your fiscal year running from July 1st to June 30th, for example. Choosing the tax year is important for keeping your financial records in order and meeting your tax obligations. Now, if you ever need to change your tax year, it's not as simple as just deciding to switch things up one day. Generally, you need to get approval from the IRS, and this involves filing Form 1128, application to adopt, change, or retain a tax year. You will need to provide a valid reason for why you want to make the change, and also keep in mind that if you switch your tax year, you may have to file a short tax year return. A short tax year return is, or rather, a short tax year is a tax year that's less than 12 months, and it can happen when you're transitioning from one tax year to another. So this means that you'll be reporting income and expenses for less than the usual 12-month period.
Let me offer some practical advice over here, Zach. So, for example, let's say that you create a corporation on April 1st of 2024. So your year commences on April 1st, which means that automatically you'll become a fiscal year because the year it consists of 12 months. So if you form the corporation on April 1st, that means that your year will commence on April 1st of 2024, and it's going to go on until 2025, the end of March. However, you have an option. So you can leave it like that and become a fiscal year. But if you do desire to consider the calendar year option, what you can do is in the first year of formation, you can file a short year tax return from April 1st through December 31st. And then without filing the Form 1128 and asking permission from the IRS, you will automatically be making that election by the first tax filing. Right there, you're saying that, hey, I choose a calendar year because my year is going to be from April 1st to December 31st in my initial year.
And so that's the short tax year, correct?
That is correct. So because that's less than 12 months, a full
Right.
tax year is a full calendar year consisting of 12 months.
And so in this case, that's the short tax year is what allows you to transition to the calendar year from the fiscal.
That is correct. Without formally asking the IRS, had you, let's say, in the initial year, file your income taxes from April 1st of 2024, through March 31, 2025, you're letting the IRS know effectively that, hey, in the initial year, I'm making an election for a fiscal year company. Thereafter, you just cannot switch like that. Then you would need permission from the IRS. So this
Understood.
is an important decision one needs to make when they set up these companies.
Got it. So now we're going to talk about employee identification numbers, which are also called EINs. So when you apply for the EIN number, you are going to have to mention when your tax year ends. So it's important to know your tax year before you begin the EIN application. An EIN is a 9-digit number assigned by the IRS. Think of it as a social security number, but for your business. It's used to identify your business entity for tax purposes and is crucial for a variety of reasons. First off, if you have employees, you'll need if you have employees, you'll need an EIN to report their taxes and wages. Even if you don't have employees, you might still need an EIN to operate a business bank account, to open a business bank account, apply for business licenses, and file your business tax returns. So essentially, an EIN helps you separate your personal and business finances, which is important for legal and tax reasons. Getting an EIN is pretty straightforward. You can apply online through the IRS website and it's free. The application process is quick and you'll usually get your EIN immediately upon completing the application. And it's also worth noting that you might need an EIN if you're forming a corporation or a partnership. Sole proprietors can often use their social security numbers, but getting an EIN is still a good idea to help protect your personal information. It is easier to get an EIN as a sole proprietor if the sole proprietor has employees, because in most situations, a sole proprietor will be using their social security for business purposes. And remember, your EIN is an essential part of your business identity, so keep it safe and use it whenever required for business transactions. So next, we're going to talk about deduction startup costs. So now that your entity now that you have set up your business entity, you have chosen your tax year and your EIN number is set up. Now let's discuss deducting those expenses. So starting a new business involves various costs, and understanding how to handle these expenses for tax purposes is crucial. Here's a quick guide on how you can deduct startup costs. So first off, capital expenditures. Initially, all costs incurred before your business is up and running are treated as capital expenditures. These are part of your investment in the business and are typically recovered over time through depreciation. Deducting startup costs. You can deduct a limited amount of startup and organizational expenses. The current deduction limit is $5,000, but this amount phases out if your total startup costs exceed $50,000. And your remaining costs are amortized over a 15-year period, starting from the month your business begins active operations. Next,
I think one
qualifying
key thing,
costs.
Zach, is that
Yeah, go ahead.
one needs to draw this line. What are pre-business opening expenses versus expenses after the business has opened its doors and commenced operations? So these are basically pre-business opening expenses. And what the IRS is saying is that you just can't deduct them like that. We'll only allow you up to $5,000 if the full amount is less than 50,000. You can right away deduct $5,000 after you've commenced operations. So these are all pre-opening expenses and they must be capitalized. Capitalized means that you have to add everything up and deduct them over time instead of
Right.
deducting them right away.
So let's say your startup costs is $50,000, and they are deductible. They aren't You don't have to use depreciation or anything. So for $50,000, the first year you deduct 5,000, right?
That
And
is
then for
correct.
the
So you are allowed
following,
5,000.
and then for over the 15-year period, it would be $3,000 per year, right?
That is correct. And the remaining $45,000 are going to be what they call amortized. So amortization is a way of recovering that expense over a period of time. And in this case, it's 15 years. So 45,000 divided by 15, thereafter is going to be $3,000 per year.
Got it. So to qualify for deduction, startup costs must meet two main criteria. They should be expenses you'd incur if you were operating an existing business in the same field, and they must be incurred before your business begins its active trade or business. So qualifying expenses can include market analysis and surveys, advertising for business launch, training costs for employees, travel costs related to securing distributors or customers, salaries for executives and then lastly, salaries for executives or consultants. And then the non-qualifying costs are certain expenses that don't qualify for this deduction, and these include deductible interest, taxes, and research and experimental costs. So for corporations, Form 1120 is used to report business income, deductions, and credits, including startup expenses. And for sole proprietors, Form 1040 Schedule C is used, while partnerships use Form 1065. Understanding these rules can help maximize your deductions and manage your startup expenses more effectively. Okay, next up, business expenses. So when claiming business deductions, there are a few key points to keep in mind. Trade or business must exist. To qualify for business deductions, you must be engaged in a legitimate trade or business.
So again, the key thing is this is previously you were talking about pre-business opening expenses. The trade or business did not exist.
Right,
Now these types of expenses are after the fact, when the business has commenced operations.
right. So last we were talking about deductions before the business opens, and now this is what you can deduct once the business has opened. So to qualify for business deductions, you must be engaged in a legitimate trade or business. Simply having a hobby or casual activity will not qualify for deductions. So you have to allocate between personal and business use. If an expense is used for both personal and business purposes, you need to allocate the costs accordingly. Only the portion related to business use is deductible. Additionally, you need to have proof of costs. It's essential to keep detailed records and receipts to support your deductions. The taxpayer must provide proof of the expenses claimed claimed to substantiate the deductions. Also, employees and unreimbursed expenses. So employees can deduct unreimbursed business expenses, but only if they meet specific criteria. This includes expenses necessary for their job that are not reimbursed by their employer.
So I just want to add something. The 2017 Tax Cuts and Jobs Act has suspended this for now. It's still there, but it has been suspended. So for now, employees are not allowed to deduct unreimbursed expenses. It's on the books, but in suspended state right now.
And you mentioned
Previously, prior to the 2017 Tax Cuts and Jobs Act changes, employees were able to deduct that. But for example, in California, California does not conform with this law. On the state income taxes, you can still deduct employee unreimbursed expenses.
and on the federal level, you said that
It's in a state of suspension right now until 2025.
is that what
And
that's when it
depending
expires, correct?
exactly, so prior to 2017, the employee's unreimbursed expenses were an allowable deduction as a miscellaneous itemized deduction. Uh, However, California does not conform with that, so California still allows that.
And then lastly, we're going to talk about ordinary and necessary costs. So the IRS allows deductions for expenses that are both ordinary, so this means common and accepted in the industry, and necessary, which means helpful and appropriate for your business. And then there's another side where we'll go more in depth in this. But on the surface, these can include costs such as office supplies, rent, and utilities. Trade or business. To qualify as a trade or business, the activity must generally be met, or the activity must generally meet several criteria. So characterized by regularity of activity and transactions, a trade or business is defined by regular and continuous activities aimed at generating profit. This means the activity should be conducted frequently and systematically rather than sporadically or casually. The entity must show that it is engaged in activities with a reasonable expectation of success. So this can include activities that are similar to or different from the primary business, as long as there is a genuine effort to achieve profit.
So
And
Zach, if
then,
you remember prior to this presentation, you were discussing, what is and what isn't a trade or business, and you mentioned the pyramid schemes, those marketing schemes
right.
or these marketing presentations. I'm sure your friends have maybe at one time invited you to, hey, come on here. And then, so what they try to sell you is that, you'll be in your own business. Or for example, they used to have these Avon, uh, products that uh, people were selling from their home. So the
Mhm.
question arises that is that truly a trade or business activity or isn't? Uh, Maybe not, because is it a regular activity with the regular transactions? So perhaps that pyramid, the marketing scheme that you mentioned, may not be a true business. It's just a gimmick that they're trying to sell individuals to think that they're in their own business.
Right. So the activity should have a history of generating income or incurring losses. Consistent patterns of revenue or losses indicate that the activity is more than just a hobby. Financial status of taxpayer and elements of pleasure or recreation involved. The financial status of the taxpayer and the degree of personal enjoyment or recreation involved are considered. If an activity is primarily for personal pleasure with minimal profit motive, it may not qualify as a trade or business. So understanding these aspects helps distinguish legitimate business activities from hobbies or personal pursuits, ensuring proper tax treatment and deductions. And then we'll go, I believe it's the next slide. Yeah, on hobbies. So we'll go more in depth on what classifies as a hobby and not a trade or a business. So yeah, a hobby is not considered a trade or a business. Activities primarily pursued for personal pleasure rather than for profit are classified as hobbies. Unlike a trade or business, hobbies are not conducted with the intention of making a profit. So when an activity is treated as a hobby, the individual typically does not expect to make a profit. The primary goal is personal enjoyment rather than financial gain. And then you
So
can,
Zach, I've personally sat through a couple of audits with the IRS where the IRS has denied that expense, for example, and they said that this is not truly a trade or business activity. So how do they do that? In general, uh, there's a code section 187, I believe. In general, if a business that you've established and consistently for 3 years or more, it's showing a loss every single year on the income taxes, the IRS says that it's perhaps is more of a hobby and not a true trade or business. So that is something that one must keep in mind, um, because we have a lot of taxpayers who have the aspirations, for example, of being self-employed, but setting up a business and supporting the business expenses and also paying for your personal expenses is not easy. A lot
right,
of times, what happens is that taxpayers have to keep their job to get a paycheck, and that paycheck is in many cases supporting that business that they're trying to establish. And that business truly generates losses every year.
right.
So the question arises that was it truly, was the effort put in, or is this just a hobby, like you're generating these losses every year?
Right. So, right. I mean, if it's hard to have a successful business and it's risky, right? If you have no consistent income, it's
Hmm.
difficult to run. Um, so yeah. So, and then also tax interest deductions are still allowed. So certain tax and interest deductions may still be applicable, even if the activity is classified as a hobby. So, for example, if you take out a loan to support your hobby, the interest may still be deductible. Then deductions that do or do not result in an adjustment to the basis of property. When claiming deductions related to a hobby, these deductions might or might not be affected, or rather, might or may not affect the basis of the property used in the hobby. Adjustments to the basis of property could impact future depreciation or gains loss calculations if the property is sold. Understanding these aspects helps ensure that hobby-related deductions are handled correctly and in compliance with tax regulations. Okay, so next we're going to talk about criteria for deductible costs. So deductible costs must be ordinary, reasonable, and necessary. So ordinary expenses are costs that are common and accepted in the industry in which your business operates. These are typical, or they are typical for the type of business you're running. And then next off, necessary expenses are expenses that are appropriate and helpful for the business. They're not just beneficial, but essential for the operation and success of the business.
So, for example, a trucking business, I think we discussed this earlier, that
Yeah,
if you're in the industry of trucking and logistics, etc., you'll expect to see expenses like trucking repairs, a truck,
right.
fuel expenses, etc. So things of that nature.
They're certainly ordinary for a trucking business, and they're definitely necessary. Can't run your
Hmm.
truck without fuel.
And they have to be reasonable also.
Yeah, so right. So reasonable expenses are costs, and they must be proportionate and not excessive. They should not be lavish or extravagant. Reasonableness is determined by considering what a typical business would spend on similar expenses. So, for example, yeah, as you mentioned, let's say you have a trucking company, the truck, the repairs, and the fuel will be ordinary and necessary, and they are also reasonable compared to your income and what the industry is. So here's an overview on specific deductions. So business meals are the first we're going to talk about. So generally you can deduct 50% of the cost of business meals if they're directly related to or associated with the active conduct of your trade or business. Next is travel expenses. So these are costs related to business travel, including transportation, lodging, and meals. And these are deductible. The trip must be primarily for business purposes.
And I think one of the things is that it must be travel away from home. So it's not just travel like from your office, let's say 20 miles from your office to some place to meet someone. That is not travel. The
Mhm.
travel has to be, away from your home.
Right. So the next is home office. So if you use part of your home exclusively and regularly for business, you may be eligible for a home office deduction. This can include a portion of your rent, mortgage, interest, utilities, and insurance. And then depreciation, this is a big one. So you can deduct the cost of business assets over their useful life through depreciation. This includes items like equipment, vehicles, and buildings. Next is supplies and equipment. So costs for office supplies and equipment necessary for running your business are deductible. This includes items such as computers, software, and stationery. Professional fees, so fees paid to professionals like accountants, consultants, and attorneys for business-related services are deductible. Advertising and marketing, so expenses related to advertising and marketing your business, including online ads, print materials rather, and promotional events are deductible. Education and training, so costs for education and training that improve your skills related to your business or help you stay current in your industry can be deductible. Employee salaries and benefits. So salaries, wages, and benefits paid to employees are deductible, including health insurance and retirement plan contributions, which we'll get into in a little while. And then lastly, rent and lease payments. So payments for renting or leasing property used in your business, including office space and equipment, are deductible. So here's some key points on capitalization. So business expenses cannot be deducted if they are capital expenditures. So these are costs that are considered considered capital expenditures must be capitalized and not deductions. So as you mentioned before, this means that they are added to the basis of the property rather than being deducted as an expense in the current year. So for an example, if a business buys a truck, that truck would be a capital expenditure because it would benefit the company long term. So capital expenses are incurred in acquiring or improving property. Capital expenditures involve acquiring or improving assets that will benefit the business over multiple years. So this includes costs for purchasing property or making substantial improvements that extend the useful life of the asset.
Yeah, one thing to note, Zach, is that a business's operating cycle is divided into 12 months. So if the business purchases an item that is going to benefit the business and is going to use up that item within the 12-month operating cycle, it is deductible immediately as an expense. However, if that specific item, like you mentioned, a truck will not be consumed by the business in one operating cycle. It's going to benefit the business over a number of years.
Right.
So those types of items, which actually will go beyond the 12-month cycle over a number of years, are called capital expenditures. And the way you recover the expense basically is by depreciation.
Right. So let's say you bought printing paper, that would be a short-term purchase, right?
Absolutely,
So
absolutely.
so that would be deductible, right?
That is correct.
But if you bought a printer, that's long-term, right? You expect that to last over a year, and therefore it'd be a capital expenditure, right?
That is correct.
Okay, so now we're going to talk about business tax credits. So they offer greater tax benefits than deductions. So business tax credits are typically more advantageous than deductions because they provide a dollar for dollar reduction in tax liability, directly reducing the amount of taxes owed. So unlike deductions, which reduce taxable income, business credits are subtracted directly from the total tax liability, making them more valuable. Deductions are subtracted from gross income, so they reduce your taxable income, lowering the amount of income subject to tax. And then most credits have their own special IRS forms. So many business credit require specific forms to be filed with your tax returns. These forms help you ensure that you qualify for and correctly claim the credits. And so there's a long list of types of business credits. So first, let's talk about the general business credit. This is a compilation of various credits that can be claimed to reduce overall tax liability. So there is the research credit, which is a credit for expenses related to research and development activities. The work opportunity credit. This offers a credit for hiring individuals from certain target groups who face barriers to employment. The rehabilitation credit. This allows a credit for rehabilitating historic or low-income housing properties. The low-income housing credit. This provides credit for developing affordable rental housing for low-income individuals. The business energy credit. This is for investing in energy-efficient property or renewable energy systems. Employers credit for FICA tax on employee tips. This provides a credit for the employer's share of Social Security and Medicare taxes on employee tips. And then the employer's credit for family medical leave. So this offers a credit for providing paid family and medical leave to employees. The new market tax credit. This is for investors who invest in businesses operating in low-income communities. And then lastly, empowerment zones. This offers various tax incentives for businesses operating in designated empowerment zones, including credits for hiring employees and investing in these areas. Okay, so now we're going to talk about hiring independent contractors versus hiring employees. So we'll compare independent contractors and employees for the following: understanding the differences between the two, legal and tax considerations, benefits and drawbacks, and compliance and best practices. Individuals or entities hired to perform specific tasks or services under contract, or this is for independent contractors, the definition. So individuals or entities hired to perform specific tasks or services under contract, and they operate as specific businesses or separate businesses rather, and usually control how and when they work. And so there are tax implications to this. So businesses do not withhold taxes for independent contractors. Independent contractors are responsible for their own tax payments, including self-employment taxes. So we'll go into that later on in depth, the estimated taxes. And then A benefit is that there's no requirement to provide benefits such as health insurance or retirement plans, and they often work on a project basis. So now for employees, employees are individuals hired to perform services for the business on an ongoing basis. They work under the direction of the business and have a regular work schedule. So there are tax implications to this as well. So businesses must withhold income tax, Social Security, and Medicare taxes from employees' wages. They are also responsible for paying unemployment taxes. And a benefit to this is employees are entitled to benefits such as health insurance, retirement plans, and paid time off. So let's talk about the legal and tax considerations. So first off, behavior control. Employees typically have more direction and control over how tasks are completed, whereas independent contractors have greater control over their work methods. Financial control. Employees are usually paid a regular wage or salary and may have expense reimbursements. Independent contractors are paid by project or task and often provide their own tools and resources. Relationship type. Employees generally have an ongoing relationship with the business, while independent contractors are engaged for specific periods or projects, or rather specific projects or time periods. And then lastly, tax reporting. So independent contractors, businesses must issue Form 1099-NEC for payments of $600 or more to independent contractors. And then for employees, businesses must provide Form W-2 to employees, reporting wages and taxes withheld.
So here, Zach, I want to add a couple of things.
Yeah.
Because you talked about control, the control aspect of the relationship. Specifically, I want to talk about the Assembly Bill 5 that was signed into law by Governor Newsom in 2019. So California basically has a three-pronged test to determine whether the person working for you is an employee or an independent contractor. So let me just read this to you. So it's called the ABC test. So there are three prongs to it. So under the ABC test, a worker is considered an employee and not an independent contractor unless the hiring entity satisfies all three of the following conditions. So basically the burden of proof is on the employer who's hiring this individual to satisfy this three-pronged test. Prong number one, the worker is free from the control and direction of the hiring entity in connection with the performance of the work, both under the contract for the performance of the work and in fact. Okay, so no control whatsoever. The second test, B of that prong, the worker performs work that is outside the usual course of the hiring entity's business. So for example, I'm a tax clinic. The person coming to provide this service to me is a plumber. Then this test is satisfied because I'm not in that business of plumbing. And the third test is that the worker is customarily engaged in an independently established trade. So for example, a contractor or a plumber, electrician. So it must be an independent trade, occupation, or business of the same nature as that involved in the work performed. So a plumber has the license. And the last thing I want to add to your independent contractor versus employee thing is that last month, the California Supreme Court actually has ruled and affirmed that Uber and Lyft drivers remain independent contractors in California, and Uber and Lyft can actually classify them as independent contractors, regardless of this ABC test.
Got it. So yeah, that was a big case. I remember that was going on for years.
Mm-hmm.
So,
That is correct.
Okay, so there are drawbacks and benefits with hiring independent contractors. So some of the benefits include flexibility in hiring and scaling labor as needed, and the lower costs associated with benefits and employment taxes. And then some of the drawbacks are there is less control over how work is performed and potential for higher turnover or less commitment to the business. And then the benefits and drawbacks with employees. One of them is there's greater control and consistency in work output. And then another is stronger commitment and potentially higher productivity. And then some of the drawbacks are higher costs due to benefit and payroll taxes and more administrative responsibilities, including compliance with labor laws. So compliance and best practices. First off is proper classification. Ensure workers are classified correctly to avoid penalties. Misclassifications can lead to legal issues and back taxes. Second, use clear contracts for independent contractors detailing scope of work, payment terms, and other conditions. For employees, have formal employment agreements outlining job responsibilities and benefits. And lastly, keep accurate records of all payments, contracts, and communications with both independent contractors and employees. And we'll get into some tips on how to keep records. Estimated taxes for self-employment. So let's talk about tax payments for the small business owner. So who must pay estimated taxes for self-employment? This means, so the federal income tax operates on a pay-as-you-go basis, meaning you must pay taxes as you earn or receive income throughout the year. You are not required to pay estimated taxes for the current year if you satisfy all three of the following conditions. First off is that you had no tax liability for the prior year. So this means that you owed no taxes last year and received a full refund of any taxes withheld. So let's say, for example, if you were a student last year and your only income was from a part-time job that did not meet the taxable threshold, you would not have any tax liability. And then next, you were a U.S. citizen or resident alien for the full year. So this means if you moved to the U.S. in the middle of last year and became a resident alien, you would not meet this condition and may need to pay estimated taxes. And then lastly, your prior tax year covered a full 12-month period. This means your previous tax year must have been a full calendar year, not a short year resulting from a significant change like a new business start, or like we mentioned, if you're changing your tax year. So let's continue with who must make estimated taxes. So as a general guideline, you should make estimated tax payments if your tax liability after accounting for withholding and tax credits is $1,000 or more. So this means that after deducting any taxes already withheld from your paychecks and any credits you're eligible for, if you owe $1,000 or more, you should consider making estimated tax payments. Second, if your withholding and credits are anticipated to be less than either 90% of the tax owed for the previous or for the current year, or 100% of the taxes owed for the previous year, provided it was a full 12-month period. All right, so here are the steps to calculating estimated tax. So first is to determine your tax or your expected taxable income. Estimate your total income for the year, including wages, self-employment income, investments, and any other sources of income. Second, calculate your expected deductions. Estimate the deductions you plan to claim, such as standard deductions, itemized deductions, or business expenses. Third, compute your estimated taxable income. Subtract your estimated deductions from your estimated income to determine your taxable income. Fourth, apply the tax rates. Use the current tax rates to calculate your estimated tax liability based on your taxable income. Tax rates are progressive, so apply the appropriate rate to each income bracket. Fifth, account for tax credits. Subtract any tax credits you expect to claim, such as education credits or energy credits, from your calculated tax liability. Sixth, Calculate estimated payments. Divide your estimated tax liability by the number of payment periods in the year, typically 4, to determine your quarterly estimated tax payments. Seventh, use IRS Form 1040-ES. To formalize your calculations, use Form 1040-ES, estimated tax for individuals. This form includes a worksheet to help you estimate your taxes and calculate your payments. Eighth, adjust for changes. If your income or deductions change throughout the year, recalculate your estimated tax payments to ensure you are paying the correct amount. Also, just a tip is better to overpay than underpay because there are underpayment penalties when you underpay your estimated tax. And then lastly, pay your estimated taxes. So submit your estimated tax payments by the due dates to avoid penalties and interest. The payments are generally due in April, June, September, and January of the following year. And just a note, you cannot get an extension on any of these due dates for estimated taxes. Okay, all right, now let's talk about the different types of retirement plans you might set up for yourself and your employees in your small business. Planning for retirement is super important, not only for the small business owner, but also for establishing a plan for the employees. But also establishing a plan for the employees helps to maintain the loyalty of your employees and incentivize your employees to stay. So understanding your options can really help you make the best choices for your small business and for those people who work for you. Here are a few of the common types of retirement plans. So the first is the 401k plan. This is one of the most popular retirement plans a small business owner can set up for themselves and for their employees. The employee contributes a portion of their paycheck pre-tax, and the employer might match a part of the employee contribution, which is basically free money. The funds grow tax deferred, meaning you won't pay taxes on the money until you withdraw it in retirement. The next retirement account we're going to talk about are the individual retirement accounts, also called IRAs. There are two main types of IRAs, so the traditional IRA and the Roth IRA. With a traditional IRA, you contribute pre-tax dollars, which can lower your taxable income for the year. The money grows tax deferred, and you pay taxes on withdrawals in retirement. A Roth IRA works differently. Contributions are made with after-tax dollars, so there's no immediate tax benefit. However, your money grows tax-free, and you can withdraw it tax-free in retirement. The third plan we're going to talk about are SEP IRAs. So SEP IRAs are ideal for self-employed individuals and small business owners. Employers can contribute to their own SEP IRA and to their employees' SEP IRAs. Contributions are tax deductible and the money grows tax deferred. Then lastly, savings incentive match plan for employees, which is abbreviated as SIMPLE. So simple IRAs are another option for small businesses. Employees can contribute a portion of their salary, and employers must make either matching contributions or non-elective contributions. Contributions are made pre-tax, and the funds grow tax deferred. Each type of retirement plan has its own set of rules, benefits, and considerations. So it's important to choose the one that best fits your financial situation, or that best fits the business. So let's talk about the best practices for keeping track of income. So now that your business is in operation, you need to lay the foundations right for your record keeping. So let's go in depth on some of these. The first off that we're going to be talking about is organizing financial documents. So here are some ways that you can organize financial documents, separate and personal finances. So maintain a distinct bank account maintain distinct bank accounts and credit cards for personal and business expenses to simplify tracking and avoiding confusion.
Yeah, this is really key, Zach. And I think we were discussing this earlier.
Yeah.
We have a lot of small business owners, basically, they don't respect the separation and they commingle both the business and the personal expenses. And that is basically what you're talking about. The separation must be respected. A separate bank account should be open for a business purpose and another account for your personal expenses. So no commingling.
Yeah. Yeah, it
That's
gets
basically what the
confusing,
bottom
I'm
line is.
sure,
Yeah.
when you have to decipher which is for which once you have to do your
Hmm.
taxes. Okay, so categorize expenses. Organize receipts and invoices by category. So for example, office supplies, travel expenses. And this is for easy access and reporting. And then lastly, use accounting software. So utilize accounting software to track income and expenses, generate financial reports, and simplify tax preparation. It's very important to maintain an accurate record. To do so, you should do the following. Keep detailed records. So document all transactions, including receipts, invoices, and bank statements. Ensure that records are complete and accurate. Document business activities. So record details of business activities such as meetings and contracts to provide context and support for financial transactions. And then lastly, regularly reconcile accounts. So periodically reconcile your bank statements with your accounting records to identify discrepancies and ensure accuracy. Now let's talk about ensuring compliance. So understand tax requirements. Familiarize yourself with tax regulations and requirements for record keeping, including the duration for which records must be retained.
One thing I want to add here, Zach, is that although this workshop is specifically talking about federal tax obligations, but a small business owner needs to consider the fact that they actually also have an obligation at the state, the city, and the county level also. So there are a lot of agencies involved. Just not just one federal agency. In that state also where they live, where they operate, there are other rules and regulations they need to be familiar with.
Right. Yeah, this presentation is pretty much all federal, so but there's a whole other set of laws at the state level. So and then lastly, uh follow legal requirements. So you have to adhere to industry specific regulations and laws related to financial record keeping and reporting. And then prepare for audits. So we actually did a presentation on this a week or two ago. So to prepare for audits, you should keep organized records to facilitate easy access in case of an audit, and ensure that your documentation supports all claimed deductions and credits. Okay, so it is very important to back up and secure records. Here are some tips on how to do that. First off is use digital backup systems. Implement regular backups of digital records using cloud storage or external drives to prevent data loss. Secure sensitive information. Protect financial data with strong passwords and encryption, and restrict access to authorized personnel only. And then lastly, store physical documents safely. For paper records, use a secure filing system or safe to protect against damage or loss. And then it is very important to seek professional advice when you need to. Consider working with a certified public accountant, also known as a CPA, or qualified bookkeeper to help you establish accounting practices, maintain accurate records, and navigate complex financial matters. So with that, that's it. Thank you very much. And again, since our services are free, donations are crucial for our support and expanding our reach. Monetary donations are greatly appreciated. Additionally, those who can volunteer their time, expertise, or help spread awareness are a great help. And if you had any questions about anything during the presentation, please email us at info@taxpayershelpcenter.com, and all of your questions will be answered by a tax professional. So with that being said, thank you all for listening and have a great day.
Thank you so much, Zach, and thank you so much for joining us today.
Thank you all. Bye.